welcome to this month's Financial Markets Update. Well, it was a pretty interesting month in terms of financial market performance over May. It really was a case of two halves in our view. When you look at the performance throughout the entirety of the month, our market was up roughly around about 2 to 2.5%. It had a pretty significant dip during the middle part of the month, and basically all of that return that we saw really came from the second half. The first half of the month, as I said, was quite a challenge, and we saw that pretty much right across global financial markets. That said, when we looked at performance of financial markets over the course of May, not only was our local equity market higher, global markets were also up roughly around about 1 to 1.5%. And bond markets also rallied. They were moderately higher on the back of yields actually declining marginally over the course of the month. So despite a number of the challenges that we saw through the first half of the month, equity markets and fixed income markets all rallied and were positive over the course of May. So what was the main issue that really faced financial markets over the course of May? And nearly that was simply inflationary expectations. Concerns about rising inflation, principally on the back of higher commodity prices, and we've seen that through a number of commodities. Lumber in the US has gone to all-time highs. We actually have seen copper and nickel also, and iron ore was up above $200 a tonne over the course of May. It was up roughly around about 14.5% for the month, and that continued on a very, very strong 3-month period where iron ore prices were up roughly around about 20 to 25%. So I've seen a significant uptick in commodity prices. From our point of view, we really think it's really just the challenges we're seeing in regards to the supply side of things. Clearly, there's a turnaround in demand on the reopening of the global economy, but we just haven't yet seen, as I said, the supply constraints and the logistical side of it actually work its way through. And so that's obviously causing some significant issues. And a really good example of that is in terms of semiconductor chips and the fact that there is still a significant global shortage on that front. And as I said, that's pushing up prices right across a number of key areas. In our view, the inflationary expectations are likely to flatten out as we move through the second half of this year. We certainly do expect prints to be higher, really over the next sort of 3 to 4 months. But as we work through the back end of the year, on a 12-month rolling basis, we do think it'll start to moderate. As I said, once those supply chain shortages start to work their way through and the bottlenecks start to ease, we do expect that inflationary pressures will start to moderate through the back end of this year into 2022. But notwithstanding that, there's a lot of positive elements associated with some of the data signs that we're continuing to see both domestically and globally. GDP footprint here was a lot stronger. We're still continuing to see good solid employment growth, albeit that it's a little more patchy now that JobKeeper has been passed out of the way. But in the context of the directional side of things, we think both domestically and globally we're in pretty good shape on that front. The speed and the rollout of the vaccine is clearly helping that, and we're seeing that, as I said, right away just in regards to the reopening of both the domestic and global economies. In the context of portfolio positioning, we haven't made too many changes over the course of the month. We continue to focus on some of those key themes, building into that cyclical-led recovery. We're doing that both in terms of our Australian equity as well as our multi-asset portfolios. We think that that'll ultimately drive performance through the second half of this year, and we feel very comfortable in the context of that portfolio positioning. We have allowed within our portfolios just to provide some protection if inflationary expectations do get ahead of us. But as I said, we certainly aren't planning for that significantly over the next 12 months or so. Continue to be underweight our bond exposure, preferring, as I said, to play that through growth assets, whether it be equities or growth alternatives across our portfolio, including real asset exposure in regards to both property as well as infrastructure, again, just to provide that diversity from a portfolio standpoint. As always, if you have any concerns about the portfolios, please feel free to reach out to anyone in the team, and we look forward to catching up again soon. Thanks, and bye for now.